Explain how the marginal cost of capital and the investment opportunity schedule are used to determine the optimal capital budget. As you can imagine, when we are trying to raise funding, the more money we raise overall, the more each additional dollar raised is going to cost. A relatively small amount of money would be cheaper to borrow than a significantly larger amount. Now, this concept leads us to this relationship between the cost of capital and the amount raised, this upward sloping curve we call the marginal cost of capital curve. Now, at the same time, the more we invest, the lower the rate of return we should expect. Substantially smaller projects will generally carry higher rates of return than the bigger projects. You have to remember that we're talking about rates of return here, not cash profits. Smaller projects may not be returning huge amounts of cash, but their rates of return are generally higher when you compare to larger projects that might carry much larger cash amounts, but typically speaking, lower rates of return. This concept leads us to a relationship between the rate of return and the dollar amount invested, called a downward sloping investment opportunity schedule. When we draw these two curves together, their intersection is a company's optimal capital budget. This is where the marginal cost of capital equals the rate of return on the investment. For any point below this optimal level, we have scope to borrow more and earn a rate of return higher than our borrowing costs. On the other hand, over to the right, at a higher level of borrowing and investment, we find that the rate of return is actually lower than the marginal cost of capital, meaning that the amount we are borrowing is costing us more per dollar than it is returning to us. Explain the marginal cost of capital's role in determining the net present value of a project. One point which is easily overlooked as we go through this material is that we are assuming that all projects have the same level of risk. This is obviously not the case. Each project will have a varying level of risk ranging from high risk to average risk to low risk. A company's weighted average cost of capital is developed as an appropriate discount rate for projects that would equal the risk level of the company as it exists pre-project. It's when the risk level of the new project is different from where the company currently stands, that's when we're going to need an adjustment. When a project is riskier than the company's current average risk level, we need to add a premium to the discount rate. In other words, riskier projects should return a higher rate to be worth the investment. Less risky projects, by the same logic, would be accounted for with a lower discount rate. Now, when we think of the NPV of a project, we are calculating the present value of future cash inflows after consideration of cash outflows. Earlier, we only looked at the case of a single initial cash outlay, but it is no great leap to think of the NPV as the present value of inflows minus the present value of all project-related cash outflows. Now, when calculating the NPV of a prospective project, this LOS is asking us to be aware of two major assumptions. One, that the capital structure of the company after fundraising for the project will be in line with the company's target capital structure, i.e., that they are not going to be intentionally driving significantly away from their target structure to fund this project with an excessive amount of debt, for example. And two, that the risk level of the new project will be accounted for in the discount rate. Describe the marginal cost of capital schedule, explain why it may be upward sloping with respect to additional capital, and calculate and interpret its breakpoints. You might remember this graph from earlier in the section when we spoke about optimal capital budgets. We noted at the time that the more capital we raise, the more it will cost. In this LOS, we need to talk about that in a bit more detail, as well as discussing breakpoints. There are two major and pretty basic reasons why the marginal cost of capital curve is upward sloping. First, let's say we issue some bonds, and after some time, we find that we need more capital. The first issue could have a covenant disallowing the issue of new debt at the same level of seniority, so the new debt is going to have a level of subordination. As always, when we issue a junior level debt instrument, we're going to have to compensate the investor with a higher rate of interest. What if we were issuing equity? As we will find out in the next section, issuing an equity security comes with flotation costs. So every dollar we raise through an equity offering costs more to get a hold of. Because of these, we end up with this upward sloping shape. Although in reality, this curve isn't a smooth upward slope like this. In fact, it would look a little bit more like this, with more discrete changes in the rate as the amount of capital rises. These points where the cost of capital changes are called breakpoints. A breakpoint marks a level of capital raised where a component cost of capital has changed. If anything occurs to affect the WACC, then that would mark a breakpoint. This simple formula can be used to find these breakpoints. Let's see how that might come together in an example. We're back again with company X. Now, as we have seen before, this company has a capital structure of 65% debt, 35% equity. We are also given rates of interest for varying levels of debt issued and varying costs of equity for varying levels of equity issued. No big ordeal here, we just need to know this formula and we can put together an answer without much difficulty. One vital thing to realize here is that there are 4 places where the cost of capital changes. One where the cost of debt moves from 3.8 to 4.3%, a second where the cost of equity moves from 5.8 to 6.9%, another where the cost of debt moves from 4.3 to 5.1%, and a fourth where the cost of equity moves from 6.9% to 8.2%, meaning that we have 4 breakpoints. Be very careful here. Remember that a breakpoint is a level of capital where a component cost of capital changes. Now, going back to the tables, you might notice that there are 3 points where the amount issued in each specific channel actually changes. One where we cross over the 50 million mark of both debt and equity, one at a debt level of 100 million where the cost of debt changes, and one at 120 million in equity where the cost of equity changes. This is a major pitfall. Don't allow this to confuse you. This is not the way we discover the number of breakpoints. It really is this simple. How many places does an actual component cost, an actual rate of interest, change? It's 4, meaning we have 4 breakpoints. Be very careful. Okay, back to the equation. We have 4 changes in component costs, so let's find the 4 breakpoints. First, when debt crosses the 50 million mark, we get a change. So let's divide 50 million by the proportion of debt in the capital structure, 65%, and that's our first breakpoint, 76.92 million. The second breakpoint occurs when we issue 50 million in equity. So here we divide 50 million by the proportion of equity in the capital structure, 35%. So the second breakpoint happens at 142.86 million. Next, when debt crosses the 100 million mark, we get another breakpoint. So we divide 100 million again by 65%, the weight in the capital structure for debt, to get 153.85 million. Finally, then we get a breakpoint when we issue 120 million in equity. So for the last time, we divide 120 million by 35% to get a breakpoint at 342.86 million. So here's all of these together. Now, if asked, you could take this a step further and calculate the weighted average cost of capital at each change in the overall amount issued and use that to draw a proper graph of marginal cost of capital. For that, you could draw up a table like this. Now note that I'm starting with a total level of capital less than the amount of the first breakpoint, and that ensures that I get the first level with the cost of debt and the cost of equity in that lowest bracket. From there, I can easily calculate the 65% and 35% amounts to show what the levels of debt and equity are at each breakpoint, how much of the total was raised in debt and how much was raised through equity. Note that each breakpoint corresponds to the various levels of capital raised in debt and equity, as we should expect. And from there, I simply line up the various levels of after-tax cost of debt and cost of equity as they occur for the varying levels of capital raised. And the last step then, given the correct tax rate, would be to simply plug in the values from the table into the equation to calculate 5 different WACC figures and plot them on the graph.